Welcome everybody to our Keiretsu Academy. Welcome everyone here in the room as well as those watching on demand on the Keiretsu TV platform. Great to have Troy and Ashley here today talk about qualified small business stock and all the different ins and outs of that. So with that, I'll go ahead and turn it over to Ashley to go ahead and get us started and take it away.
Great. I'll just provide a brief introduction and turn it back over to Troy to he'll help sort of clarify why it is we're here and what qualifications we have to be talking about QSBS. We are not here to provide tax advice. We are here to provide broad education. I am a director in Bernstein's Wealth Strategies Group. Bernstein's Wealth Strategies Group really is focused on conducting research and analytics not on the investment side, but on the wealth planning side. So I like to think of it as sort of looking at the intersection of the capital markets and personal finance as it relates to topics such around income and estate tax planning. QSBS really sort of fits squarely in the middle of that, as we're here to sort of stay on top of what's new and what's changing and making sure that the folks that we're working with are staying educated about the topics so we don't hear stories like what Shallow was saying, where they had an exit and didn't have the information prior to when taxes needed to be filed, and there may have been a missed opportunity there. So we just want to make sure that we're getting out in front of people and making sure that the entrepreneurs that we're working with, as well as their professional advisors, are aware of the opportunities that exist today. Before I delve deeper into some of the content and address many of the questions that I heard sort of leading up to this, I'll turn it back over to Troy. Just to kind of take you through, let's start with my disclosure page in case that was missed. Bernstein does not provide tax or legal advice, but we will arm you with the questions that you need to know so that you can have educated conversations with those professionals.
Thank you, Ashley. So most of you know me and most of you know Bernstein. For those who don't, I'm going to give just a very quick overview which will help explain why we're here today. So we have been around for 52 years. We're in 25 different countries and we manage over $500 billion. What's important on this slide that I want to point out is, one, we have zero long-term balance sheet. It's rare for a firm of our size and what we do, I think, today. The other thing is, right in the bottom right, 100% of our revenue comes from investment research and management. And that's one of the three things I want to leave you with about the firm. This is all we do. It's all we've ever done for 52 years. And so when you compare ourselves to our global competitors who are in a lot of different lines of business, this is all we've ever done. So I think that's one thing that's really important to understand. Two is the fact that we are actually money managers. And so in today's world where vast majority of our industry actually outsources to a third party to manage money and investments, we don't do that. We manage the money ourselves. We actually design, build our investment portfolios. There are some areas that we outsource to regarding private equity and some hedge fund stuff, but the vast majority of who we are, we're the money managers. And the third piece I'll leave you with is, we're known in the industry for our research. We've got researchers all across the world, from the offices that we have in the 25 countries. They're spread out to give us better insights into what's going on. And a big part of that research is the group that Ashley is a part of. And so we bring in people from industry, whether they're CPAs or corporate attorneys or trust estate attorneys or actuaries and more. And they left private practice. They come on board with Bernstein and our Wealth Strategies Group, and they publish research on of importance to our clients. And so some of these here we've got listed, whether it's investment planning or estate planning or educational events like QSBS. And so it's really important for us to be able to impart that to our clients. And that's part of what we're doing today. So, and maybe before Ashley jumps in, who here, raise your hand if you have some experience with QSBS. Just a little bit.
I know what it means.
Okay. And then maybe it'll help. What are you hoping to get out of today beyond just, what QSBS is? Anything in particular, or just in general education? Yes, ma'am.
At least two of the companies where I'm a board member might be appropriate to be on top of this.
Okay. Good. Anyone else? Yes, sir.
Just kind of understand the difference between this, the vehicle, versus other options that are out there.
Okay. Yes, sir. Mark?
Better ways to classify failed startups.
failed startups?
Failed startups that bring tax benefits, stuff like that, the tax loss carry forward and stuff.
Okay. Well, how much we'll dive into that in this piece, but we can certainly talk.
Yeah, I know it's not
Yeah.
exactly the same thing.
That's all right. Okay, so, the great thing about this particular presentation here is it should be of importance to angel investors who are investing in companies. It should be of importance to founders of companies. And it should be of importance to executives of companies who get stock issued to them. And so I think we pretty much covered that group here. Anything else I should add before you jump in? All right. We'll let Ashley take it away.
Great. So as Troy mentioned, the group that I'm in really spends our time conducting research and analytics and staying on top of anything that is new or changing sort of in the planning landscape to help entrepreneurs and investors. QSBS isn't actually new. It arose in 1993 under the Clinton administration, effectively as a way to incentivize the formation of and the investment within small businesses by providing a substantial tax benefit when those companies are sold through the way of avoiding federal taxation on all or a portion of the gain within those companies at the time of transaction. And while it's not new, it's been around since 1993, the tax benefits were dramatically reduced for a substantial period of time. One, based on sort of the nature of the QSBS qualifications, sort of how much gain you were getting to exclude. And two, we saw another big hit around the Bush-era tax cuts. When tax rates declined dramatically, then the avoidance of capital gains tax on all or a portion of your gain wasn't as interesting because tax rates were so much lower. Now we're in a position that we'll go through here some of the details in just a minute, where the amount that you're able to exclude has gone up substantially and been made quote-unquote permanent, as anything is permanent within our tax code. And because tax rates went up so substantially in 2013, we saw the top rate go from 15 to 23.8%. Excluding some of that gain from federal capital gains taxation makes a very, very big difference. So let's talk a little bit more about sort of what is this QSBS topic. So essentially what we're talking about is, subject to these requirements, if you meet the qualification and you sell your company stock, you can exclude from federal taxation the greater of 10 million in gain or 10 times your basis. So when we're talking about entrepreneurs, people who have founded their company, for the most part, your basis in that asset is relatively small, potentially close to zero, and so therefore the greater of those two is really going to be the 10 times basis. So that's, or I'm sorry, the $10 million gain exclusion. So that's primarily what we're going to focus on until we shift to talking about an opportunity that exists with company formation structure and how that might change it. And so that's been true for a long period of time, since 1993, but what has changed is, particularly coming out of the financial crisis, the amount of the gain that you're able to exclude has increased. So when this first came into play back in 1993, you were able to exclude 50% of your gain, up to 50% of up to 10 million of your gain, if it was acquired between 1993 and 2009. Then what you see is, as you get into the early part of 2009, and most importantly, the latter part of 2010, that exclusion amount went up from 50% of the gain that could be excludable to 75 or even 100% of the gain that could be excludable. So that means if you had $10 million of gain in your company and you were subject to a 23.8% tax rate on that transaction, you could avoid close to $2.4 million in tax. That's obviously a very substantial benefit. So this is why we're sort of talking about this, and this is why this topic has come back into vogue, really just in the last couple of years. We saw basically this really came back in 2015 because after you had that late 2010 period where 100% of the gain was excludable, the other qualification to sort of meet the standards for qualified small business stock gain exclusion is you have to have held the asset for at least 5 years. So if you acquired the stock sometime in 2010, by the time you hit 2015, we started seeing people going through some transactions where they were able to take advantage of this gain exclusion. Now here we are in 2019, and so it's sort of really picking up steam sort of as we go through. So this is really the incentive. You may be able to avoid 2.4 million of income tax or potentially more. Again, in this specific case where we're dealing with an LLC to C Corp conversion, which we'll talk about more in just a minute.
And this is each individual shareholder, so where there's multiple founders, each has this exclusion.
Absolutely. 1202 is an individual benefit. We'll talk about some interesting opportunities there when it comes to potentially gifting shares of stock and getting a multiplier effect. But yes, this applies to every individual taxpayer. So how do you actually qualify for this? I heard you guys talking about this sort of in the beginning of the session today. The most important thing is, in order for your stock to be qualified, it has to be original issuance C Corp stock. So this only works for C Corps, so S Corps, unfortunately, no. LLCs on the surface, no, unless they're converted later to C Corps. So that means you either had to have founded the company, or maybe you're a key employee who's receiving shares directly from the company, or their stock was being delivered to you directly from an underwriter or something. And importantly, it has to be ownership of the stock, not a derivative of the stock. So owning an option doesn't count. You have to have actually exercised the option and owned the actual stock. And importantly, when it comes to that, that 5-year holding period clock doesn't start until you exercise the option. So make sure you're sort of thinking about when the actual ownership of the stock itself sort of has triggered. And of course, it has to be a US-based C Corp. Stock can be either common or preferred, as long as it was directly issued to you by a C Corp. And then importantly, the other qualification is it has to be a non-corporate shareholder. This is meant to be an individual benefit, not a corporate benefit. So it doesn't work if the stock was issued to an S Corp. The S Corp doesn't get any sort of benefit. Where you do have some potential is with pass-through entities. So if, for example, your stock was issued to an LLC, which is taxed as a partnership, or a C Corp, any other pass-through entity can qualify for this QSBS gain exclusion as well. So then we move on to, so that's the original issuance is the first one, then we move on to the next qualification, which is what is small, when we're talking about qualified small business stock. The qualification there is that the business must have less than 50 million of gross assets at the time of issuance, so when the stock was issued to you. Importantly, that is a gross asset test. It is not a valuation test. So the company could be valued substantially more than that as long as the gross assets fall below the 50 million in gross asset test. In addition, there's also an active component, so at least 80% of the assets have to be used in active trade or business. The sort of good thing on this is there's actually some degree of leniency on this test when it comes to the first 2 years beyond a company's formation, in that they have carve-outs for working capital and capital being used for R&D. Again, that only qualifies within the first 2 years. After you pass that first 2-year mark, only 50% of the assets can be utilized in that way to still count towards this 80% active component test. And then, of course, the big one is the business itself has to qualify. And of course, because it's the IRS code section that governs all of this, they don't define what does qualify. They define it in the negative, and they tell you what doesn't qualify. There's a whole list of things that don't qualify. It's very, very broadly defined. The general takeaway is that service-related businesses don't count. So unfortunately, Troy and I are out of luck here. Being in the investment management space, we provide investment services. We're in a service-intensive business, so we don't count. Other things, it's delineated in the footnote here. I'll just read some of them to you. health, law, accounting, engineering, architecture, actuarial sciences, basically anything that is a service-related business where you are sort of the key provider you are the key asset is not going to qualify. What's interesting here, though, is just because you are in sort of the healthcare service or I heard some healthcare-related businesses that may be here as well, doesn't necessarily mean you are out. It really has to do with what service you are providing. So if you are a healthcare company who is not providing, direct medical advice, rather you're producing some sort of technology in the healthcare space, that could qualify. And again, there hasn't been a lot of rulings on this yet. We haven't seen a lot of case law, but there have been a few cases. We expect to see more and more as more people start taking advantage of this. But there have been some very positive rulings where there have been some pharmaceutical companies that sort of, on the surface, you might think those aren't going to qualify based on sort of this negative description of what's a qualified business. But the service took an actually very narrow reading of this, and because those pharmaceutical companies were producing things like technology or other goods that weren't service related, they actually did end up qualifying. So just an important one to keep in mind. If you think you have a business or an investment in something that sort of is on the fringe here within the gray area, finding a really good attorney who's very knowledgeable within the QSBS space, they can look at it and provide you an opinion letter. Again, you can just sort of use it to line your files if this opportunity ever comes up for you.
Along those lines, if you need a referral to an attorney who's in the space, because we deal with a lot of tax and accounting professionals and different types of attorneys, let us know, just reach out and we're happy to refer someone that might be a really good fit for you.
And then lastly here, the stock has to be held, as I mentioned, for at least 5 years from the date of issuance. Again, that's from issuance of the stock, not a derivative of the stock. So convertible bonds don't count. The option itself doesn't count. It's when it's transitioned into an actual stock holding. Yeah, great.
As I'm reading the fine print down there,
Yeah.
You've got in section E, business operating a hotel, motel, restaurant, or similar businesses. Would that technically preclude a apartment complex fund, a real estate fund, something around that?
Potentially, yes.
And Nathan's sitting there going, yeah.
Real estate has plenty of their own tax breaks. So.
I realize that, but it's wrapping it up in a fund.
Well, it sounds like a fund is the problem because then you're not issuing stock to individuals.
Well, but earlier she said that if your fund was if an LLC is a pass-through entity, this will pass through to the LLC, to the members of the LLC.
That's right.
Interesting.
So that's why
So like a
that's why I'm
VC fund.
asking that question.
This should still work.
Absolutely. So it's not just for founders or key employees. There is definitely an opportunity for investors as well. Perfect.
For instance, any investments our funds make, our co-investment funds, all this benefit flows through to the underlying investors in our funds, the fundamental portfolio companies.
The thing that's tricky is the documentation piece and making sure that you're actually paying attention to sort of what is the holding period. Did the company qualify? Did it meet all of the qualifications? We can talk about this more in more detail, but there is no filing requirement with this. It's not as though you have to submit anything to the IRS that shows that this company was a qualified small business. It's really up to you to determine whether or not you qualify for this. You simply claim it on your Schedule D, and then it's just a matter of whether you get audited. And if you get audited, then hopefully you've got your paper files lined with the documentation that you need that asserts that you have reason to believe that at the time that the stock was issued, it met all of the qualifications. This last bullet, that the stock continued to meet the active business requirements and was a C corporation during substantially all of the taxpayers' holding periods, and not just when it was issued, but at least for substantially all, however that's loosely defined over this 5-year holding period. So it becomes particularly tricky, again, when we're dealing with investors. If you're the founder of a company, this is sort of the note to self: start making documentation, line your files for yourself and for your employees, so that they can take advantage of this and have everything they need to the extent that there is an audit. There hasn't been that much yet that's come up, so we don't have a lot of information sort of on how the IRS is going to be handling cases like this and how frequently these audits are going to occur. But again, just being as prepared as you can be.
So like stick away quarterly balance sheets so you can assert where 80% of your assets were?
Probably not a bad idea. I think again, there is no specific requirement in terms of what documentation that you have to have, but just making sure that specifically at time of issuance, you've got something that indicates that you met the gross asset test at that time, that 80% of the assets were used sort of in the active trader business. You'll have documentation that indicates that you were a C Corp for substantially all of your holding period. Stock certificates on sort of when the stock was acquired and how it was issued to you. All of that becomes critically important. We've got a slide in here that just sort of classifies the different flavors of original issuance. Again, as we said, it has to be original issuance C Corp stock. Can't be a derivative of it, so stock options, restricted stock units, convertibles, preferred, and convertible debt don't count until it actually becomes a stock. So upon the exercise of the option, upon the vesting or the 83B election for restricted stock, upon the vesting of restricted stock units. So this is just a table that indicates when the QSBS qualification test has to be met and at what point the 5-year holding period starts. We have several sort of case studies in here that sort of shows some of the benefits and does some of the quantification, but I think what's the most interesting to spend time on here, and based on some of the questions that I heard around the table, really gets to what are the opportunities to be aware of, and what are the pitfalls as well, what can trip you up. Happy to address anything on this list, but I thought I would start with the LLC to C Corp conversion because that's the one that I was hearing questions about. So as I mentioned in the beginning, the benefit here is that you can exclude from federal taxation up to 10 million or 10 times your basis. So again, if we're talking about founders, what we're really talking about is the $10 million gain exclusion because their basis is probably pretty limited. However, if you started as an LLC, and again, none of this counts unless you have original issuance C Corp stock. If you started as an LLC that then converts to a C Corp, your basis is the value of the company at the time of the conversion. So if the value of the LLC was $1 million or more at the time of the conversion, then your 10x basis might provide you more opportunity to exclude from federal taxation greater than that $10 million mark, and potentially substantially greater than that $10 million mark, provided that at the time of the conversion and the new stock is issued, you still meet all of the other qualifications, less than 50 million in gross assets and 80% of the active business required assets are used in active trader business. So this becomes important because a lot of times when we're talking to entrepreneurs, you wouldn't necessarily think of doing evaluation at the time that you're doing the LLC conversion, because why would you? This maybe is a reason to do that, to ensure that you qualify as a qualified small business and that you can, again, line your files so that if there's a transaction down the road and you have the opportunity to take advantage of some of this gain exclusion, you have what you need down the road. Now, any gain that was built into the company at the time of the conversion from LLC to C doesn't go away. You will be taxed on that. It's just the conversion itself is a non-taxable event, and you'll have to pay tax on that sort of stub gain on the end. It's really about the gain over and above once the C Corp was issued. Any questions on that? Perfect. So yeah.
What if you convert to an SPC?
That's a good question.
Is an SPC just a special version of a C Corp?
I don't know. I don't want to answer that directly. I'm not 100% sure.
Okay. It's a Washington State Social Purpose Corporation?
Yeah.
As the impact investor in the room?
Yeah. I think that would count, but I want to put a pin in that. I don't.
We'll get back
just
and
in case.
clarify.
Yeah.
Is it technically a C Corp? An SPC?
I think it is.
Yeah. I think
For
it is
federal
too.
purposes.
And for federal purposes,
Yeah.
I think it is a C Corp.
Taxed.
Yeah.
Because
So-
this is federal, this is, state doesn't matter here.
That's right. That's right. And if we're
Okay.
talking about just for sake of being west, we obviously don't have a state income tax we have to worry about here in Washington, but for California purposes, since we deal with a lot of folks in California, California does not conform to the federal standard. So if you're a California investor and you sell something, you will get the federal gains exclusion, but you'd still have to pay California state income tax on your dollar of gain. So it's up to the state whether or not they conform.
Even more tax-free Washington.
That's right.
Again,
That's right.
tough to be an entrepreneur in California.
So again, LLC, if you formed initially as an LLC, that keeps the door open, again, because, provided you convert prior to, bridging the qualification requirements for QSBS. S Corp is substantially trickier. If you start as an S Corp, you could convert to a C, but again, the C Corp would have to issue new stock at that point in order for anyone to qualify for that. So that's an important one to keep in mind.
Wouldn't that make sense if to convert from an S to a C, for the C to acquire the S Corp and not convert, but just spin up a new C Corp and acquire the S Corp into it?
Yeah, that could work. That could work. Another thing to keep in mind is the gain deferral under IRC 1045. 1045 is essentially like 1031, but for qualified small business stock. So where this comes into play is when you're really close but not quite there in terms of meeting that 5-year holding period requirement. This could be important for investors, but also founders as well. So if you started your company 3 to 4 years ago, you weren't necessarily planning on an exit, but the right buyer comes along and takes you out, but you've only held your company stock for 4 years, you might think, shoot, I didn't meet the 5-year holding period requirement, I had a lot of gain built up in my company, but I'm not going to get to exclude any. Pay attention to 1045. There's an opportunity to stretch that holding period by basically doing the 1031 exchange for QSBS by rolling the proceeds within a 60-day window, so it's a short window, into a new qualified small business stock. If you do that, your holding period and your gain tax over. So if you either start a new company or you invest in another company and again, receive stock for that transaction, then your holding period tax, you can hold on to that new company stock for the next 1 year, get up to the 5-year holding period, then have an exit and qualify for the $10 million gain exclusion. Not always appropriate, of course, because if you got to start a new company, you do have a little bit of grace period in terms of that working capital requirement, so you don't really have to be totally up and running, but you got to find another buyer for that one. So you still need to make sure that you have an opportunity to get your money back out if that's what you're looking for. But I'll start here.
So and you don't get a new $10 million, you just basically get in the original 10.
That's right.
Okay. And that's the main question.
Does the exclusion apply only in case of a sale? What happens if the founder goes IPO?
Yeah, so that counts any sort of transaction that would trigger the gain. This also qualifies when there is another interesting opportunity that we see is stock-for-stock transactions. So if your company, this is another one that people don't necessarily think of will allow them to qualify. If they have qualified small business stock, maybe you've held that stock for 3 to 4 years, so you haven't met the 5-year holding period requirement, and you get acquired by Big Co. See this a lot with Amazon, Google, Microsoft acquires your company, and you get stock for that transaction, not cash. That stock actually will tack on to your holding period requirement, so that when you sell Big Co stock in the next, once you meet that 5-year holding period requirement, you still get some of your gain exclusion. You don't get to exclude any of the gain that occurred after that transaction date, but any of the built-in gain at the time that your company was taken out or acquired still qualifies. So you just sort of have to segregate the gain between, qualified your small business and then Big Co. Big Co gain's always going to be federally taxable, but you can take advantage of some of the gain exclusion.
And we're just concerned about the first $10 million partition. I mean, if you sell for more than that, you're independent to do whatever you want with that. It's just that $10 million has to be. basically.
Yeah, so you get to exclude from gain, let's assume that the stock was acquired after 2010, 100% of the gain up to 10 million. So if your company gets, if you had qualified small business stock that had 20 million of built-in gain, 10 million of that will be excluded from federal income tax purposes. The other 10 million will be subject to traditional long-term capital gains.
So when you're
rates.
talking these transitional strategies of stock for stock, it's really just that first 10 million you're concerned with.
Yeah, that's right.
The rest of it, you're free to do whatever you want.
That's right. Any other questions on, so we kind of talked about a couple, 1045 and Big Co acquiring scenarios. One of the things I wanted to mention based on something that Shala brought up was one of the really big pitfalls that we run into is stock redemptions, where stock redemptions, if you're not very, very careful, can actually blow QSBS not only for the redeemer, but for anyone else who acquired stock within a 2-year window around when that redemption occurred. So the reason that I mentioned that this is particularly important for anyone who sits on a board, usually these redemption requests will end up going through the board. Hopefully the board is educated on this topic and can work with them to design a strategy such as not to blow this redemption qualification. So basically, let me see if I've got the qualifications in here. Redemptions. Okay, so the pitfall, again, it impacts both the redeemers and the shareholders, and it has to do with if you are redeeming any more than what's determined a de minimis amount, and de minimis, by the way, is quite small. It's anything that exceeds $10,000 or more than 2% of the stock, if you're the redeemer held by the taxpayer, then that for the redeemer, QSBS status is lost for any stock that was issued to that redeemer within a 4-year window around when the redemption occurred. So 2 years before and 2 years after. So that's substantial. So maybe that owner says, well, I don't really care about myself. I'm happy to blow my QSBS status. My gain in the company wasn't that big, or I just need to be redeemed. The important thing is it impacts every other shareholder. It's a narrower window. It's a 2-year window around the redemption. So for stock that was issued within up to 1 year prior and 1 year after the redemption occurred, QSBS status will just be blown for any of those shareholders. So really important for people to keep this in mind. Maybe there's strategies that people can. We're not here to opine on sort of how you navigate this issue. But there are things that you can do, whether it's sort of split, redeeming slowly over time, finding another entity or investor, to redeem them, so you're not actually redeeming through the company. The code does have carve-outs for exceptions to this redemption rule, things like termination, death, divorce, disability. But otherwise, if one of the founders just wants out, redemption is something to be very, very cautious of. Provided that you're taking anything more than a de minimis amount off the table.
So that sounds pretty harsh. So
It
I'm
is
going to just
very
affirm
harsh.
that. Everybody loses their thing. Like, the game is up.
Yeah.
Wow.
Within a 2-year window, so for
Before
all
and
of the
after, all stock
shareholders, before and
issued
after.
before and after.
Yeah.
So you've either got to know you're not going to raise any money for 2 years, and you haven't raised any money for 2 years.
Quantify de minimis?
De minimis, it's defined differently whether you're a shareholder or the redeemer, but for the redeemer, it's greater than $10,000 or 2% of your holdings. From the shareholder's perspective, it's more than $10,000 and more than 2% of all outstanding stock.
And so it's most likely to come up like exiting a founder.
Yes, that's the most
So
common case.
termination of services, if you fire a founder,
Yeah.
then that might hit the exemption?
Yeah.
Ouch, okay. For the good of the rest of us.
Yeah, right.
You're fired.
Right. So this is what you just want to be quite creative and try and find another way to get them out.
Huh, but here's the thing, if a founder wants out for any number of different reasons, right? And he's redeeming his shares, what does he care if he got fired? I mean, honestly, who cares?
Yeah.
It wouldn't matter, he's leaving. So you make it official that he was fired, and it wouldn't affect at that point.
have a question. So this is redeeming through the company. So if the founder wanted to get out and sell that stock to new investor, would that also count? No.
That's okay.
That's okay.
Because
That's
that's not a
okay.
redemption.
Because it's not a redemption.
Okay.
That's right.
Just
So
a
you gotta,
sales. Yeah,
that's the way that most
Right.
people are,
Yeah.
are sort of
That's
trying
the
to
way
deal
to
with
do
this. You gotta find somebody else to sell your stock to. Yeah.
So how would you define redemption? Redemption means you pay cash for shares and there's nothing else like in that case.
Yeah.
This is like a company buyback of the stock,
Yes.
is what this is.
So it's
This
not
isn't,
redemption.
Yeah.
I guess.
yeah.
Yeah, selling it back to the company.
Take it back, yeah.
So also this has implications for revenue-based investing, because a lot of revenue-based investing is structured, the way Pledge does it, it's structured as a stock buyback. So you sell 6% of your company and you pledge to buy back 3% over time at 2 to 3x of what you sold it for. And that's how investors get their money out and still have 3% in, but none of that would count for this tax exemption. Okay, thank you.
One of the other ones that I wanted to mention on the opportunity side is gifting QSBS. So this question came up in terms of this being an individual benefit where you yourself is limited to the greater of 10 million or 10 times basis. But what if there could be any number of taxpayers? We don't necessarily see this with a first-time entrepreneur, but potentially with somebody who is a serial entrepreneur who's had other significant exits in the past. They themselves are set up financially. They don't necessarily need substantial amounts of proceeds from their next business. And if this next business that they've started is wildly successful, such that they have substantially more than 10 million of gain to potentially exclude, is there a way to capture more benefit? And interestingly, there is, because if you gift shares, the holding period for those shares and the basis of those shares tax to the transferee. So if I started my company, it was wildly successful. I don't need all of the gain, for my portion, and I have potentially more than 10 million of gain within that company that could be otherwise eligible for exclusion. I might gift Troy some of my shares, my holding period tax to him, my basis tax to him. The stock remains a qualified small business stock. All of that still qualifies. Troy now gets his own $10 million of gain exclusion. And that counts whether or not I give it to an individual or to a taxable trust for the benefit of an individual. So maybe I've got 4 kids who are all too young to sort of really benefit from or be prepared to take on $10 million of wealth, but I could put it in a trust for their benefit, and as long as the trusts are their own unique, have their own unique tax IDs and are truly their own entity for unique individuals, there is nothing in the code that limits how many people you can gift to get this sort of multiplying effect. So in theory, if I had a company that was worth $100 million or had $100 million of gain, and I was going to have an exit from that company, I could gift it to 9 other people plus myself and have all of that gain be exempt from federal taxation. Again, not necessarily something that we're seeing for the solo entrepreneur, but or for the single-time entrepreneur, but for serial events, it's something that we have to work with. Importantly, the entity has to be a taxpayer, so if you're gifting to a trust, it has to be a taxable trust. Structures such as grantor trusts, where the tax flows back through to the individual, does not count. That's a question that we actually have been working on with the client is, what are the trade-offs associated with a taxable trust that has to pay its own tax but may get this gain exclusion versus a grantor trust where the grantor is paying all the tax, the trust doesn't pay any tax, but you don't get the 10 million of gain exclusion. How do you sort of weigh those trade-offs? That could be an incredibly interesting question.
We're working with an entrepreneur and founder of a tech company down in Portland who's going through this exact same thing. Wants to gift some stock to his kids. They want to set up a trust, so these are all questions we're helping them to navigate.
That doesn't have any impact on the timing. It's still 5 years from grant date.
Yeah, so the timing of the, your holding period just taxed to whoever you gifted to. So if I founded my company 3 years ago, and that's when, of course, the stock was issued to me, and I gifted to Troy now has qualified small business stock with a 3-year holding period.
So it actually doubles, triples, quadruples, whatever you have.
Yeah.
That many people give it out to.
Yep. So the key is, you may not necessarily want to start giving your shares away before you know how much the company is going to be worth. You don't know if it's going to be a home run or not. If it's not, you may want to have all that capital accrue on your own balance sheet. But again, for people who have had multiple exits in the past and are sort of taking care of themselves, this is an interesting opportunity.
And that includes trust, not just family members.
That's right. Yeah, as long as the trust is a taxpayer. Yeah. And right now, there is no Washington State gift tax. At the federal level, you can give up to $11.4 million away per person. So that falls well within the $10 million of gain that you might be otherwise gifting, assuming it's zero basis. There are lots of other strategies that you can use without using up your gift exemption to transfer wealth off your balance sheets. There's another interesting case study in here about being mindful of sort of how you structure those. A lot of those vehicles are initially structured as grantor trusts, so you just want to sort of time it in a way where you increase the probability that the actual transaction occurs once the asset is outside of the grantor trust. If it happens inside the grantor trust, it falls back on your own balance sheet and you don't get the multiplier effect. Particularly relevant for things like grants, if you're familiar with those. We're seeing that a lot.
So I'm particularly interested in the large cash injections, since the
Fundraising.
life cycle of an early stage company
Yeah.
involves
Fundraising
Yeah.
is important. So if you're going to get a big round, the important thing is to think about sort of what does that do to your gross asset test, and does it then mean you have, because you've got all that cash, that you're not meeting the 80% of the assets being used in active trader business. Again, this one is a little bit tricky because the way that it's defined is that you have to meet the qualifications for QSBS through substantially all of your holding period. So it might be okay if that round comes in sort of at the tail end of people's holding periods, as long as it met for substantially all of them. With the holding period, again, that's very loosely defined. There is no, it's not like 2 years and 264 days, that's the cutoff. So it's a little bit of a gray area there, something that you certainly want to consult CPAs and your attorneys on to get opinion letters on that kind of thing. But just something to be wary of, that a large round of fundraising could mean that for stock issued after that point, certainly it doesn't qualify because you've exceeded the 50 million in gross asset test.
I guess I was just thinking more if, you have 50% of your assets, you've just raised a round and 50% of your assets are sitting in cash because it's your next 12 to 18 months of burn.
Right.
Does that mean you no longer meet the 80%?
You might not. It depends on how early the company is, because remember there is that, while 80% of your assets have to be used in active trader business, there is a grace period sort of within the first 2 years of company formation where there's carve-outs for working capital and R&D, but after the 2 years, only 50% of your assets can count towards that, up to the 80% threshold. So again, it just depends on sort of the timing of when that round comes in.
Okay, yeah. Because it seems like this is going to be harder for software companies than for manufacturing companies.
Yeah, potentially.
Quick question.
Yeah, please.
From a raise standpoint, if a company gets a PE firm or a VC firm to toss down $5 million, for instance, but they have them dole that out over a 2 or 3 year time period, would that be enough to keep it within that 80%? In other words, they've got a commitment for $5 million on the table, right? But they're going to get in the first 6 months $1 million of it. The next 6 months, maybe 500. Kind of an as-you-go type fee.
I don't know how they look at that. That hasn't come up before.
And a lot of times this will have performance milestones.
Right.
So that might help to
Right.
be like, you didn't necessarily get the money up front.
Right, it was
Right, you got a commitment.
true capital at risk, if you will. Yeah, interesting. We can look into
How
that.
does this work in terms of grants? Like, let's say you get a grant from NIH. It's very similar to, the grant is approved, but you don't get the whole amount. You get it in chunks. So as the grant comes in, that's what counts towards your assets, or is it the entire amount that's approved?
That's a good question. I'm not sure on that front. We'll double check on that.
Yeah, make sure I get your card and we'll follow up. And Craig, I'll follow up with you on the other one.
Great, thanks.
And so this is the sort of thing where we should talk to a corporate accountant, or like should we talk to our own accountant? This is like a company.
Yes. So because it's an individual benefit, it really comes down to,
So the CEO's accountant.
yeah, and any of the shareholders should be working with their own tax counsel. In fact, one of the cases that I saw coming out of California was it was actually an employee of a company who had original issuance C Corp stock. The company had just gone public, so they had an opportunity to sell their stock. They were looking to see if they qualified for QSBS. They didn't know. They didn't have any of the documentation in terms of, did the company meet the gross asset test? Did it meet the working capital test at the time that their stock was issued? So they went back to, founders and CEO and said, hey, how do we stack up? Does this count for all of us employees? Founders had never heard of it, and were just learning about it at that time. And they said, hold on, this is a massive benefit for all of our employees. So nobody sell. Let's figure out sort of what's going on so that we can, make sure everyone's on the same page. And that company actually did go back through all of their records and created basically packets of documentation for all of their employees. So again, it's just about education and making sure people are aware the company can provide what they need to provide. And fortunately, that the shareholder had a CPA who knew about the fact that this could be a benefit for them to take advantage of. And so they were able to ask the right questions early on, early enough to sort of learn more about it. I know we're right up at 1 o'clock. We'll sort of close with just our summary slide in terms of documentation. Again, there is no sort of requirement in terms of anything that needs to be filed. So maximizing chances of qualifying, keep clear records, data purchase, amount paid, share certificates, get the company to provide you with proof of the fact that the company's a C Corp, that it had, met the gross asset test, met the active business test. Again, if you are in an area of business that sort of falls within that gray area in terms of what is considered a qualified business, obtaining an opinion letter from an attorney that really specializes in QSBS is important. And then making sure that you're involving, a whole team of professionals around these issues that are well versed, that can help you understand the benefits and opportunities, all the way back to company formation. A couple years ago, may not have been that common that we were seeing companies structure themselves as C Corps. And so, although with tax changes recently that made C Corp taxation substantially more favorable, plus you have this opportunity for gain exclusion, we think we're probably going to see more than that. We're seeing a lot more conversions from LLC to C, which is creating some really interesting opportunities, again, where their basis is greater than $1 million at the time of conversion. That's helping as well, and taking advantage of the multiplier effect. If you've got a company that's has been substantially effective, thinking about gifting early on prior to when the transaction occurs, so that gain is occurring within the balance sheets of different taxpayers, so you can get more than the $10 million gain exclusion.
And it's not the basis, it's the determination, it's valuation?
the 10x basis is based on basis, but your basis in the C Corp after you do a conversion is based on the value of the LLC at the time of conversion.
I'm actually circling back to the original founders. So if original founders purchased stock for a de minimis amount, but the actual asset, the corporation, was worth more than that, is it the amount that was paid actually the basis of the stock?
Yes. Yeah.
And remember, it's not the valuation of the company, it's the valuation of the assets.
Well, for basis purposes, for determining the
For that,
10x
yes.
basis, yeah. The gross asset test is not valuation of company, it's asset valuation.
Well, we got time for more questions, so if you guys have any specific questions that we can answer on this or anything else exciting.
Yeah, I'm curious, who do you see using this most? The type of business industry?
Really, I've seen it all over the map. Trying to think of the couple companies that I've worked with so far. There has been a technology company. There's been clothing company. Manufacturing. Distributing.
I've said we're seeing a lot of the manufacturing leaders of consumer good-related goods or high tech.
People with assets.
What if your manufacturing business is licensed manufacturing versus you actually running the manufacturing plant yourself?
I haven't seen it, but it's not, as long as it's not considered service related, which that wouldn't be, I don't think.
Might be because
Yeah.
We're always available if you think of something when we run out the door.
So on your opportunities slide, I noticed you had LLC to C Corp. Is there S Corp to C Corp opportunity as well?
Potentially, it's just much trickier because you'd have to actually issue new stock once the company is a C Corp. So the converted stock doesn't count, it has to be original issuance C Corp stock.
Earlier, the better.
Yeah.
So, if you created a C Corp 4 years ago that had really nothing in it, right, as a shell, and you took your S Corp, we'll just say 2015, you took your that C Corp bought your S Corp that gets all the S Corp tax advantages in 2019, would you have a 1-year hold?
Good question.
I think what the issue could be if the C Corp wasn't really doing anything, could you argue that it met the 80% active assets being used in the active trader business? Probably not. And there has been case law where somebody tried to do something similar, but it wasn't an S acquisition. It was somebody who had started a company, the company was acquired, they took the proceeds, rolled it into a shell company that was defined as it was a jewelry company. They met the qualification, or they had the grace period where they didn't have to have their assets. The 80% of the assets being used in active trader business was considered working capital and R&D within those first 2 years of the jewelry company's formation. They held that company for 2 years before it was sold, and the entrepreneur attempted to claim QSBS. IRS came in and said, you sold one piece of jewelry for $10,000, you weren't really doing anything with the company, you don't meet the test, they didn't get anything.
Sure,
So
I'm just
they're
thinking from
looking
a
at it.
roll-up.
Yeah.
From a roll-up perspective, a roll-up entity would possibly be able to, if they were, say they're guys going out buying dental offices or veterinary clinics, right? If they owned a veterinary clinic to begin with in a C Corp, right? And they went out and bought, acquired additional companies, additional vets or dental offices, right? They were S Corps. Would they be able to run that back through? It's an interesting question because you'd be able to convert it.
For the vet owners that then got, or for the vet businesses that got acquired?
Correct, because they'd
They'd have to receive new issuance C Corp stock, which they could, but then their holding period starts over at the time that that stock acquired.
yeah, I'm more interested in the, in the original, with that original entity, we'll just say, Vetco A,
Mhm.
right? Started in January 1st, 2015. They buy Vetco B in June 1st of 2019, right? The Vetco B, they didn't do their
They're
stuff
right.
right? But that new acquisition just increased the, let's say double the value of Vetco A,
I see what you're saying.
right? Would that new valuation effectively double Vetco A's valuation from a QSBS perspective?
Interesting, yeah.
But wouldn't they not qualify because it was investing
Services.
and it was a service business?
Well, yeah,
Service
whatever.
side.
yeah, it doesn't
Something
matter, I'm
that's-
just using
Something
that.
that's
Yeah.
qualified, yeah.
Yeah.
okay.
Something that's qualified.
That might work. That might work. Let's make a note of that and we can follow up on that and see if we've seen that before.
So, yeah.
I mean, this is sort of the beauty of this space that we're in because this hasn't really been tested. If you can find tax and legal partners who are willing to be a little bit more aggressive with you on that, I mean, we're seeing people sort of range the spectrum in terms of how aggressive people are willing to be and sort of push the limits and then see what case law comes out of that and follow in the footsteps of it. You know, it's worth a shot.
So you had a lot of slides that you weren't able to cover, pretty information-rich deck. Is that available to us?
Yeah. Most of the stuff that's in there is just going through and actually quantifying some of the examples in showing how some of this stuff actually works out, like an example of LLC to C Corp conversion and getting to sort of take advantage of that. So it's just some of the more quantification stuff. I think most of the content we did cover.
I
But
think in
yes.
about 3 years I'll be pulling that out of the file cabinet.
Yes.
What was that?
Yeah.
Yeah,
Exactly. Yeah. There's a lot to sort of be aware of.
Yeah, we've got a copy, so we'll make sure that gets out to everybody who registered to attend, along with the recording, so if you want to, revisit it again and hear it again, you can catch up on it, and that's also why it's real important, we do the due diligence packages on the companies, we make sure there's always the financials in the due diligence, so that we've got the basis for when you make your investment, we actually have the due diligence package, and hopefully that will be helpful in informing, qualified small business stock designations, should have all the information in there about the company when you made your investment, all the disclosure from the company. I mean, that's what you need to be able to, provide that along with your investment information to your tax advisors to be able to make those determinations in terms of the original. And most all the companies we see through Keiretsu, unless they're a very high valuation company, 100, 200 million, most all of them are going to qualify for this if they're corporations. So it is a big benefit of being a part of the group and being able to make these kind of investments. And ideally, the ones that work out very well. Obviously, you get to write off the losses. We didn't talk about what happens on the other end if you lose your money, but there are, in our Tax Academy, benefits on the other end. If the company's not raised more than $1 million, you can write off 100% of your investment against your regular income. If you do that really early stage seed funding, the first $1 million into a company. But that's a topic for another day. Unfortunately, that is, you want to maximize your losers and you want to maximize your winners, and it's really important you're set up with the right structure and the right advisors. So thanks, Troy, thank you actually for being here. I'll get out their contact information with the presentation materials. So do really encourage you to make sure you have the right advisors. Doing angel investing is a lot different than anything else in terms of entrepreneurial activity. So you got to make sure you have people that understand what you're doing and the benefits associated with it. And most regular financial professionals don't. So we really encourage you to seek out, and we've got a lot of referrals and folks that we know that our members have worked with that have a lot of good advice and experience working with a whole variety of situations. So depending on your exact circumstances, it's important to keep all the records, keep all the information, and be able to track everything so that when we get the good results, the fact you can donate, as a founder, you've got large equity holdings. And I guess I didn't quite understand myself, I thought it was 10 million or 10 times, the lesser of. not the greater of. So I didn't realize there was that much founder benefit for the entrepreneurs themselves, and I'm not sure how many of our CEOs and founding teams really appreciate that. There's a, you know, so if they sell the company for $10 or $20 million, I mean, there's a good chance that all the founders are going to get 100% of their gain tax-free if they've taken advantage of this. So Casey will add another checkbox in the due diligence handbook there to make sure we
Write it down.
check this off. So we got about 15 more minutes. If we have any other questions here, we can jump into them.
So if you have a business that's part service and part technology development, do you have to spin it out into its own corporation to get that benefit, or can you segregate it within the company?
I don't know. I don't
Because
know.
there are a lot of companies that are both.
Yeah, yeah. All I can say is from the case law that we've seen, that the IRS has been fairly lenient up until this point in terms of what qualifies. So if there is a component that is not service related, you know, that may be enough to kind of get you through. But
I'll get an answer for you.
seek legal counsel is probably going to be the answer, and get an opinion letter.
Well, I've got an engineering company
Yeah.
that doesn't qualify,
Right.
but has a technology development component to
Right.
it that we could either spin out or just
Yeah.
track.
This is a good reason to spin things out of service businesses, and you got a product idea or technology
Well,
idea, spin it out.
When I sold, we looked at this because we were software as a service, right? And, you know, we're not, nobody sells shrink wrap software anymore, right? You're providing a service around it. I got that at the time that it was a service, and you're out of luck, right? I
So you
mean,
get a 20% of your
but
assets just
that
sitting on
was,
it,
that was in 10, right? As we were starting to get ready for sale, right? But it's changed. I don't know what that, Troy, that'd be a really good question. What about software as a service? Because, I mean, you have an asset, there's an asset value in software, in that technology, and whatever IP there is, right? But if you're not selling a downloadable piece of software, you're providing, you know, a web-based software as a service, where does that fit into the, especially around here? Because
It's coming up a lot also in like in the fintech space.
Right.
In particular. And in early indications have seemed to show promise that might qualify, because it's the technology that's the real.
So the license.
yeah, maybe
Yeah,
the selling
it's
the
a real-
license, but we looked at it, and like I said, in '09, and that it was nascent at best at that time, and that I had guys from New York and here and San Francisco look, and they went, nah, you're SOL.
Yeah, I mean, as I think about like, okay, imagine this being implemented, I'm trying to think, do I need quarterly financials or annual financials? But all the IRS is gonna have 10 years down the road to challenge you on is the corporate tax filings, which is basically an annual corporate report. And on there, it's gonna be the equivalent of a balance sheet, and they're gonna be able to do some stupid math and be like, X% of your assets weren't in, you know. I mean, that's probably all they are gonna have to judge on. So it's what's on your balance sheet.
Unless they go back and do
It's
an
also gonna be
audit.
when you acquire the stock too. So you're gonna need that, and
Yeah.
you're gonna wanna see, as a shareholder, you're gonna wanna see that, you're gonna wanna be able to turn around and say, at least I've got this straight line, and we dropped here, we went up, right? I mean,
Yeah.
I don't know.
So close all your rounds in January?
Yeah, I guess there's a question, if you raise too much money, in today's environment, there's a lot of capital out there. We hear about these mega financing rounds, and certainly those are blowing way through this. So for your normal angel kind of retail funding rounds, you know, unless a big family office comes in or something and makes a large investment, and usually it doesn't get to the point where there's that much money sitting around for that long. These entrepreneurs tend to figure out how to spend it a little faster than we might think. And hopefully you're generating revenue at the same time, so the cash flow is coming through, and there's not a lot of, the cash is getting flowed through the business and hopefully generating more revenue. Although maybe.
Can you
All right, any other questions?
talk a little bit about the intersection between this and the 83B election? I don't recall the details. I know we went through an analysis, decided we didn't need to do it, but I don't recall why.
Anything with restricted stock grants
Yep.
versus options?
Yeah,
Does
so-
that impact this?
Yeah, it does, so it really comes down,
That is why owning the stock in the restricted form is better than an option because it starts your timeline.
well, it has to vest. So the restricted stock has to have vested to start the holding period, or you have to have done an 83B election to start that clock. So that's the requirement there. Simply holding the restricted stock prior to vesting does not count.
So buybacks would apply then? Reverse vesting where they could actually buy back a percentage of it?
If you don't file the 83B. So if you get the restricted, file the 83B, pay the nominal tax on it, then you're fine. Otherwise, it can be a big problem down the road. I've heard of some entrepreneurs that have poor legal counsel that have really gotten in a tough pickle around issuing restricted stock and not doing everything exactly correct. So you gotta be careful with it. You don't want to miss the opportunity to take advantage of that. Other questions?
If you need my card, don't have it, make sure you grab it before we take off.
So for anybody who's a guest today, make sure you get a chance to check in with Amy. She's our newest team member, our membership director. And for those of you who have guest sign-in forms, go ahead and drop those off with Amy, chat with her a little bit. We'd love to have you as a member of Keiretsu, and we have our big spring-summer membership drive going on here the next couple months. So Amy will be following back up with everybody. And we've got our deal screening next Wednesday. So hopefully you'll be able to join us. Thank you, Bernstein, Troy, for hosting our deal screening. And we've got a great set of companies coming in June for the forum meetings. And so it should be a very fun and active summer. So hopefully everybody had a great Memorial Day holiday and had a chance to rest up a little bit. And we're really looking forward to a great end of the month here and getting June started with the viewers. So thank you guys again for being here. And Casey or Amy, anything else to wrap up with?
Someone mentioned something about adding something as a checklist to something in due diligence. I was doing,
Related to
I was
QSBS.
working, so I missed that one part. But on that note, I'm in the process of updating a due diligence handbook. So if anybody has anything they want to add and want to sit down and talk about it, and things that you want to see in due diligence or have questions about in due diligence, I'd love to sit down and talk about it so I can get some more perspective and just understand expectations as to how we want to move forward. So feel free to reach out to me directly. I will make time for this, as this is a big project here, so I'm excited.
Super. Right. Ashley, thank you guys very much.